Welcome to the Deep Dive, your shortcut to getting up to speed.
Today we're unpacking the latest from Matson Inc. That's ticker MNEW.
Yep, diving into their second quarter 2025 earnings call. We'll hit the highlights, look at what drove the numbers.
And importantly, what management is signaling for the rest of the year.
Okay, so let's jump right in. Big picture for Q2.
Well, they delivered a pretty solid quarter overall. Definitely beat expectations on the key metrics.
Right, so diluted earnings per share, the EPS, came in at $2.92. That was a beat of 74 cents, which is, about 34% above what analysts were looking for.
Exactly. A very strong beat there. And revenue, too, $830.5 million. That was over $103 million higher than consensus. So, headline numbers looked great.
Looked great, yeah. But despite those beats, the consolidated operating income was actually down year over year.
It was. And that feeds into the market reaction, which was, interesting. The stock only closed up about 1.24% the day after the call.
Which, for those kinds of beats, seems a bit muted.
Muted is a good word for it. It suggests investors were looking past the Q2 numbers and maybe focusing more on the outlook and some underlying trends.
Okay, so let's peel that back. Let's get into the pivotal financials beyond the headlines. That operating income dip, where did that come from?
So consolidated operating income landed at $113 million. That's down $11.6 million compared to last year. And the drop came from both ocean transportation and logistics.
And the ocean transport piece specifically.
That was down 9.5% year over year. Management pointed directly to lower volumes in the China service as the main reason.
Okay. So that China volume is clearly a key factor. How about EBITDA?
EBITDA for the quarter was $163.6 million. That's down a bit from $171.5 million in Q2 of 24. Tracks pretty closely with that operating income pressure.
Got it. But you mentioned bright spots earlier.
Yeah, the SSAT joint venture, their terminal operation partnership, that contributed $7.3 million. That's a jump of $6.1 million compared to last year.
Wow, that's a significant increase. What drove that?
Mostly higher lift volume through the terminals. So good performance on that side of the business definitely helped cushion things a little.
Okay, interesting. And what about the interest lines on the income statement? I saw some movement there too.
Right. So interest income dropped to $8 million from nearly $19 million last year. But, and this is important, that Q2 2024 number included a one-off $10.2 million interest payment from a federal tax refund.
Okay. So apples to apples, the underlying drop wasn't quite so dramatic.
Exactly. And on the other side, interest expense actually went down by $4 million year over year. That's mainly because they've been paying down debt.
Shows good discipline on the balance sheet. So pulling it all together, net income.
Net income for Q2 was $94.7 million. That's down about 16.3% year over year.
But we should probably also mention the share count, right? They've been buying back stock.
Absolutely. Diluted weighted average shares outstanding were down 5.3% year over year. That reflects those ongoing buybacks, which helps boost the EPS number per share.
Okay, so that covers the core financials. Now let's talk operations, because you mentioned that divergence between domestic and international. How did the different trade lanes perform?
Yeah, it really is a tale of two stories. Domestically, things look pretty solid. Hawaii container volume was up 2.6% year over year.
Driven by what? General demand?
General demand, yeah, and also strong construction activity. They specifically mentioned the Maui rebuilding efforts contributing there.
Okay, and Alaska?
Alaska volumes were also up slightly by 0.9%, mostly due to higher volume on their AAX service.
Guam was the exception domestically then?
Just slightly. Guam volumes dipped 2.2% year over year. But overall, the domestic picture is one of, resilience.
Resilience, yeah. Contrasting sharply with China.
Sharply is right. China service container volume decreased by 14.6% year over year in Q2. That's a pretty significant drop.
And management tied that to
market uncertainty, volatility from tariffs, global trade friction, basically all the headwinds we've been hearing about.
It sounded like a real roller coaster within the quarter, too. Lower demand early on, then a rebound.
Yeah, they described lower freight demand in April when tariffs kicked in, then a snapback in mid-May after a temporary tariff reduction was announced. Plus, you had customers pulling freight forward before a July deadline. Lots of moving parts.
But interestingly, despite that volume drop, their freight rates in the China service held up.
Modestly higher year over year, yes. They really emphasize their premium service, their expedited offerings, and brand reputation, allowing them to outperform the general market, like the SCFI index.
So that premium positioning is key to navigating these headwinds.
Yeah.
How else are they adapting strategically?
Well, a big focus is expanding transshipment. So cargo originating outside of China but moving on their China service vessels.
Right, diversifying the sources.
Exactly. That represented about 21% of their China service volume in Q2. That's up quite a bit from 13% in Q1.
And that includes new services.
Yes, they highlighted new expedited services out of places like Vietnam, mentioning a Ho Chi Minh service specifically. They're positioning themselves to support customers who are shifting manufacturing around Asia.
Makes sense. They seem committed to maintaining those fast, reliable trans-Pacific services wherever the freight comes from.
Absolutely. And they sounded maybe a bit skeptical about whether competitors' expedited services can really last if spot rates stay low, given the high costs involved. It's like they're playing the long game on service quality.
Okay, that strategic adaptation is clear. Let's circle back to capital allocation and the balance sheet. You mentioned buybacks.
Yep. They continued strongly in Q2, repurchased about 0.9 million shares for just under $94 million. Year to date, that's 1.4 million shares for about $163 million.
And dividends.
Declared a quarterly dividend of $0.36 per share payable in early September. So consistent shareholder returns remain a priority.
And the debt picture, you said they reduced it.
They did. Total debt was down to $381 million at the end of Q2. They also refinanced their credit line, entering a new 5-year, $550 million facility, replacing a larger $650 million one.
Why the smaller facility?
They indicated lower capital needs going forward. The big Aloha-class vessel program is almost fully funded now, and the next major Jones Act shipbuilding cycle isn't really expected until the mid-2030s.
So aligning their credit availability with their projected needs. Smart.
Seems like it. Very disciplined financial management overall.
Okay, so that's the Q2 performance and strategy. Now, the crucial part, the outlook. What are they telling us about Q3 and the rest of the year?
And this is where that caution really comes through. For Q3, they expect ocean transportation operating income to be, and this is their word, meaningfully lower than the $226.9 million they did in Q3 last year.
Meaningfully lower. Okay, why the drop?
Primarily due to expected lower freight rates and lower volume year over year in that China service. Plus, they explicitly guided towards a muted peak season.
Muted peak season.
Yeah.
That definitely stands out. What about logistics for Q3?
They expect logistics operating income to be comparable year over year, so some stability there.
Got it. And for the full year 2025, any changes to the outlook?
Yes, they actually raised their outlook slightly for ocean transportation operating income for the full year. They now expect it to be higher than their previous guidance,
Okay.
but still moderately lower than the $500.9 million they achieved in 2024. So better than they thought before, but still down year over year.
And full year logistics.
Expected to be comparable to 2024. They also gave some other full year numbers. Depreciation around $200 million, interest income near $31 million, and an effective tax rate of about 22%.
So near-term caution, especially Q3, but maybe a slightly less pessimistic view for the whole year compared to 3 months ago?
That seems to be the gist of it, but that muted peak season comment hangs over Q3.
Let's talk about that. What's driving the muted peak season expectation, according to them?
They pointed to a couple of things. One, customers seem to have managed their inventory levels pretty well. And two, some of that freight pull forward that happened in May and June ahead of the tariff deadline might have borrowed some demand from the traditional peak.
So maybe not a collapse in demand, but more of a timing shift and better inventory control.
That seems to be the implication. It also ties into the broader uncertainty. They flagged tariffs, global trade shifts, the U.S. economy, geopolitics, all creating a less predictable environment.
And that connects to their long-term strategy too, right? Betting on diversification away from China.
Exactly. They see that as a continuing trend, which reinforces their strategy to build out services from places like Vietnam.
And on shipbuilding, interesting, they don't feel pressure to lock in U.S. shipyard slots yet, despite the talk about needing more U.S.-built ships.
Yeah, they basically said the economics aren't there right now for building internationally trading ships in the U.S. without significant subsidies, and their next domestic Jones Act need is still over a decade away. Very pragmatic view.
Okay, so bringing it all together for someone looking at Matson, what's the key takeaway here?
I think it's that clear divergence. You have a really strong Q2 performance, beating estimates significantly.
Right, solid numbers in the rearview mirror.
But then you have this cautious near-term outlook heavily influenced by the China trade lane and this idea of a muted peak season.
And the market reaction reflects that tension. Investors are clearly weighing that future uncertainty against the past strength.
Precisely. Which leads to the big question. How much can that solid domestic performance and their smart capital management really offset the volatility they're seeing internationally?
Yeah, that's the balancing act. They're focused on transshipment, premium services. That's their strategic bet to navigate this shifting landscape long term.
It's definitely a compelling strategy, even with the bumps expected in the near term.
Okay, so let's pivot slightly. Time for our This Is Not Financial Advice segment. Given everything we've discussed, the strong Q2, the cautious Q3, the China headwinds, any outrageous but plausible trade ideas spring to mind?
Okay, disclaimer first. Purely hypothetical, not advice. But if you wanted to play that specific divergence, the Q2 strength versus the meaningfully lower Q3 guidance,
Go on.
you could consider something like selling some out-of-the-money call options on MADX, maybe with an expiration date just after the Q3 earnings are expected.
Okay, so the thinking there is,
The thinking is you capitalize on that cautious sentiment and the expected muted peak season. You're betting that the China headwinds will likely cap any major upside in the stock price in the very near term, even with the domestic strength.
so collecting the option premium, betting against a big near-term rally without actually shorting the company long-term.
Exactly. You benefit if the stock stays flat or drifts down slightly into Q3 earnings, reflecting that cautious guidance. The risk, of course, is if Q3 turns out way better than expected or sentiment shifts and the stock rallies hard past your strike price.
A tactical play on the near-term outlook versus the longer-term resilience. Interesting thought experiment.
Thought experiment only.
Absolutely. Okay, so wrapping this up, Matson's Q2 really showed their operational strength and financial discipline in a tough environment. Strong beats, good shareholder returns.
Definitely. But their own forecast for Q3, that muted peak season and the ongoing China uncertainties, they clearly signal challenges ahead, particularly for the international side of the business.
It really underscores the complexity of global shipping right now and how companies like Matson are trying to adapt strategically.
It does. Lots to watch there.
As always, remember, this was just for informational purposes. Please don't take it as financial advice. We definitely encourage you to dig into the reports yourself.
Yeah, form your own conclusions. And maybe think about how that strategic pivot towards transshipment could really play out for them long term.
Good question to ponder. Thanks for joining us for this deep dive into Matson's Q2. Until next time, stay informed.